Welcome back to the Daily Crypto Roundup. Over the last 24 hours, the crypto market has continued to digest yesterday's sell-off. And in the last half hour, we've seen another leg lower. This move hasn't come out of nowhere, and importantly, it doesn't change the broader picture we laid out yesterday. If anything, it confirms it. Bitcoin has slipped again, extending the downside that began over the weekend. Ethereum and the major altcoins have followed, with losses accelerating briefly as key intraday levels gave way. There hasn't been a new headline, a fresh regulatory shock, or a sudden failure driving this move. Instead, this looks like a continuation move, the market reacting to the tone, positioning, and sentiment that were already in place. Yesterday, we talked about how fragile conditions were. Liquidity was thin, leverage had only partially been flushed, and the news flow was cautious rather than supportive. That combination matters. When markets don't get reassurance, they often drift lower under their own weight. That's exactly what we're seeing now. This latest drop appears to have been triggered by technical levels breaking rather than new information. As price slipped, stop-loss orders and remaining leveraged positions were forced out, creating a short burst of mechanical selling. Analysts at Kaiko have repeatedly highlighted that in environments like this, price action can move faster than sentiment, because automated orders dominate short-term flows. What's important to understand here is that this is not panic. Volume hasn't exploded, funding rates aren't collapsing, and there's no sign of disorderly selling. This is the market continuing to reprice risk after yesterday's tone made it clear that confidence was still lacking. Charles Schwab's digital assets team noted earlier that once a market starts to drift under cautious conditions, follow-through moves like this are common, especially when buyers step back and wait for confirmation rather than rushing in. In that sense, this move was expected. After yesterday's news, the lack of a strong bounce, and the continued macro uncertainty, the path of least resistance in the very short term was lower. That doesn't automatically imply a deeper breakdown, but it does reinforce that the market is still in a recalibration phase rather than a recovery phase. With that context in mind, what becomes more interesting is not the dip itself, but what happens underneath it. And that's where the next part of the story comes in. Let's take a quick look at the prices. Bitcoin is currently trading just under $75,000 at $74,997, while Ethereum is sitting around $2,205. Binance Coin is trading near $755. XRP is around $1.56, and Solana has slipped back to just under $100 at $99.25. Tron is holding around 28 cents. Dogecoin is trading near 10 cents. And Cardano rounds out the top 10 at roughly 29 cents. Taken together, this latest dip doesn't change the broader picture. It's a continuation of the repricing we expected after yesterday's tone and news flow, and the market is still working through that adjustment rather than reacting to new information. Let's move into the latest headlines that's shaping up the market today. In the United States, lawmakers introduced a new version of a long-discussed crypto market structure bill in the Senate. The proposal aims to clarify which digital assets fall under securities law and which should be treated as commodities, effectively drawing a clearer line between the responsibilities of the SEC and the CFTC. This is not the first attempt at such legislation, but the timing matters. Previous efforts stalled amid political gridlock and uncertainty over enforcement priorities. This time, analysts note a shift in tone. The bill focuses more narrowly on jurisdiction and oversight rather than attempting to regulate every corner of the crypto ecosystem at once. Legal analysts following the bill say its chances of passing are still uncertain, especially given election year dynamics. But the introduction alone reduces regulatory ambiguity. Markets tend to react not just to rules, but to clarity. Even imperfect frameworks can be preferable to unpredictable enforcement. From a market perspective, this story matters less for immediate price action and more for institutional participation. Asset managers, banks, and pension funds care deeply about legal certainty. Each step toward a defined structure lowers the perceived risk of engagement, even if full adoption takes years. Across the Atlantic, Europe delivered a very different regulatory signal. the European Commission issued formal warnings to multiple member states for failing to implement new crypto tax transparency rules on time. These rules require crypto service providers to report transaction data to tax authorities, aligning crypto reporting with traditional financial systems. At the same time, the Commission raised concerns about Hungary's domestic crypto regulations, warning that certain provisions conflict with the EU's unified MiCA framework. Specifically, Hungary introduced criminal penalties for some crypto service activities that are permitted under MiCA, creating legal fragmentation within the bloc. European analysts say this is Brussels asserting control rather than attacking crypto itself. The message is that crypto is allowed, but only within harmonized rules. For exchanges and service providers, this means stricter compliance but also clearer operating conditions once enforcement stabilizes. For users, the impact is more subtle. Privacy expectations will continue to narrow, and cross-border platforms may limit services in certain regions to avoid regulatory complexity. Europe is choosing structure over speed, and while that may slow innovation, it reduces uncertainty for institutions looking to operate at scale. From Europe, the most significant regulatory shift of the day actually came out of Asia. South Korea announced that it is lifting a long-standing ban on corporate crypto investment. For nearly a decade, South Korean companies were prohibited from holding digital assets on their balance sheets. That restriction is now being rolled back, allowing publicly listed firms and licensed financial institutions to allocate a portion of their capital to cryptocurrencies. The initial framework limits exposure to a small percentage of equity and restricts eligible assets to the largest and most liquid cryptocurrencies. Transactions must go through approved domestic exchanges, and full reporting requirements apply. Analysts see this as a quiet but major development. South Korea has one of the most active retail crypto markets in the world, but institutional participation has been artificially constrained. Allowing corporate balance sheets into the market introduces a new class of long-term holders. Importantly, this move comes alongside stricter enforcement against unregistered foreign exchanges. South Korea is not deregulating, it's selectively opening access while tightening oversight. That balance is increasingly common across Asia, where governments want the economic upside of crypto innovation without losing control of financial stability. India, by contrast, moved in the opposite direction. Indian regulators introduced new Know Your Customer requirements for crypto platforms, including live biometric verification, location tracking, and enhanced monitoring for higher-risk users. Exchanges are also being discouraged from supporting privacy-enhancing tools such as mixers. Local analysts say these measures effectively raise the cost of participation to the point where many retail users may exit regulated platforms altogether. Combined with India's already high tax rates on crypto transactions, the new rules are likely to push more activity offshore rather than eliminate it. This highlights a broader trend. Some jurisdictions are competing to attract compliant crypto capital, while others are prioritizing control even at the cost of innovation. For global markets, this creates fragmentation rather than a single regulatory narrative. Next, we move to one of the more concerning stories of the last day: security. A cross-chain bridge protocol suffered a significant exploit, resulting in the theft of roughly $3 million worth of digital assets. The attack involved a vulnerability in how cross-chain messages were validated, allowing an attacker to spoof transactions and release funds without proper authorization. The team behind the protocol halted activity quickly and launched an investigation. They also offered a white hat bounty in an attempt to recover the funds. While the dollar amount is relatively small compared to past exploits, the mechanism is familiar. Cross-chain infrastructure remains one of the most vulnerable areas in crypto. Bridges are complex, handle large volumes of assets, and often rely on intricate messaging systems that can fail in unexpected ways. Security researchers have repeatedly warned that bridges combine the risks of multiple blockchains into a single point of failure. Analysts at CertiK noted that this exploit fits a broader pattern. January was one of the worst months for crypto security incidents in nearly a year. What makes this trend more alarming is that the largest losses didn't come from smart contract bugs alone, but from phishing and social engineering. One incident last month involved the theft of hundreds of millions of dollars from a single hardware wallet user after their recovery phrase was compromised. That attack didn't exploit code. It exploited human trust. Exchanges and wallet providers are responding by adding scam detection tools, transaction warnings, and behavioral monitoring. But analysts stress that no amount of software can fully eliminate human error. As crypto matures, the weakest link increasingly isn't technology, but users. This security backdrop feeds into a broader conversation about infrastructure and development, which brings us to the next story. Despite market volatility, development across the crypto ecosystem continues. Decentralized trading platforms are rolling out new products, including prediction markets and advanced derivatives. One prominent decentralized exchange reported record volumes after testing new features that expand beyond traditional spot and perpetual trading. At the same time, traditional financial institutions are quietly expanding crypto exposure through regulated products. In Europe, major banks have begun offering crypto exchange-traded products to retail clients within existing brokerage accounts. These products don't require users to manage private keys and operate fully within regulatory frameworks. Analysts say this reflects a shift in how institutions approach crypto. Rather than embracing full decentralization, they're integrating crypto exposure into familiar financial rails. This may not appeal to purists, but it lowers barriers for mainstream adoption. There's also growing convergence between crypto, artificial intelligence, and traditional tech sectors. Several large firms are hiring crypto specialists to explore blockchain applications in data security, payments, and infrastructure. While these efforts are early stage, they suggest that crypto's role as a foundational technology is still evolving, even when prices are under pressure. As we approach the final part of today's roundup, it's worth stepping back and looking at what ties these stories together. Markets are volatile, but not chaotic. Regulation is tightening, but also becoming clearer in key jurisdictions. Security risks remain, but responses are improving. Institutional interest hasn't disappeared. It's simply become quieter and more selective. Analysts remain divided on near-term price direction. Some warn that macro risks could push crypto lower if global markets deteriorate. Others argue that much of the leverage has already been flushed and that structural support is building beneath the surface. What's clear is that this is not a euphoric market, and it's not a broken one either. It's a market in transition, recalibrating expectations after a period of excess. Volatility is likely to remain elevated. Headlines will continue to swing sentiment. But beneath that noise, development continues. Capital is positioning cautiously, and the long-term structure of the crypto market is still taking shape. That's where we'll leave it for today. As always, take a step back from the minute-to-minute price action, focus on what's actually changing, and we'll be back with the next update. And as always, we'll see you at the top.